Hey, good morning. This may be a little dry. It's all about condominium financing this week, and it's a bunch of text. Some good news and some interesting news. The 50% owner occupancy of a project requirement has been eliminated for investment property financing in established projects. What that means is that more investors may be able to buy into communities that have a little less than 50% or a lot less than 50% owner occupants living in the properties. That's good. Uh, but then, now effective August 3rd, uh, there's going to be no more streamline or limited reviews. This is both Fannie Mae and Freddie Mac. They're going to retire their streamline or limited review options, resulting in more condo projects requiring a full project review. And we'll go over just what that is in just a second. The impact is that financing may become more challenging for associations that do not have an adequate amount of reserves or high delinquency rates, or if they can't provide the comprehensive documentation that we need in a timely fashion. And what is that stuff? Okay, part of the page break here. This is late breaking stuff. The typical documentation required for a full project review is our condo questionnaire, the current association budget, their master insurance policy, and any engineering inspection or structural reports completed within the past 3 years. In with that association budget is, cash reserves that they have on hand, proving that out as well. So that could create some challenges for some of the more slipshod or older communities where it's tough to even find a human being, right? We'll see how that plays out. Now, January 4th, 2027, coming up this coming January, the minimum condo association reserve funding requirement is going to go up from 10% to 15% of the association's annual budget as of January after New Year's. Regarding their whole budget, they have to have 15% of that in cash, basically, somewhere. The impact is projects that do not qualify for a project review waiver may have difficulty meeting the eligibility requirements if their reserve funding is down at that time. Say they just finished a big project and haven't collected from the HOA owners and members. They haven't collected everything yet from an assessment. If their budget falls down, we're going to have a tough time having someone who wants to get a mortgage finance that property. Associations that are unwilling to increase reserve contributions or who don't have a current reserve study supporting a lower income funding level justification may not be eligible for traditional financing. So buyers and sellers in affected projects could experience reduced financing options and longer transaction timelines. We have to wait. We can't finance this thing until the HOA collects its assessment from its members for the new roof or whatever they did. So it could be something we have to learn more about as we shop for condominiums, what's going on with the project. What it means for buyers, if you're working with buyers considering a condo purchase, it's more important than ever to have a project review early in the transaction. Early review can help identify and detect financing concerns and avoid bad surprises. We have a condo department here. I regularly I'll look something up and see if it's FHA approved or if it's VA approved. Now we're going to have to dig deeper on these things for your listing or for something that a client may want to be purchasing. So there we have it this week. I'll have this in print. We also have a flyer so that you can refer to it. And of course, call, text anytime. Thank you very much. Have a good day.